Welcome to Real Estate Live, where your questions get answered. We get to the point with hot topics that everyone is talking about twice a week. We go live at 9 a.m. Pacific time on Monday and Friday on YouTube and Facebook. Today's hot topic is about if we'll see lower interest rates coming soon. Think like under 3%, so maybe even sub 3% interest rates. To make sense of the mortgage rates, today's special guest is a great loan officer with Fairway Mortgage, Celeste Harvey. We'll pull the curtain back on the mortgage rates, the mortgage market update for today, which is going to be updated forbearance guidelines, the lower interest rates, myth versus fact, and what affects mortgage interest rates, plus much more. After we get through these topics, we'll dive right into the live viewer Q&A session. I'm your host, Andrew Finney with King Realty Group in beautiful Las Vegas, Nevada. Quick reminder, please feel free to use the link in the show more description to join us on the screen at any time during this live stream. If we missed your question, please post it in the comment section and we'll circle back to it and get it answered for you. For now, without further ado, let's go ahead and bring up Miss Celeste Harvey. Hi, Celeste. Good morning.
Good morning, Andrew, and happy Margarita Friday to all of my YouTube friends out there. Thank you so much for tuning in today.
Yeah, I think you're going to start. I think you're going to start a hashtag Margarita Friday movement now, right? So,
yeah,
if anyone ever wanted to do anything solid for Celeste, send her a gift card for like a margarita, and she will love you for life.
Yep. That is very true. So let's get this party started. I know you all are interested to hear about what's going on with mortgage rates today. So today, the bond market's flat, stocks are flat, interest rates are at historical lows. We're seeing interest rates in, the low to mid threes, really just depending on what loan program you're in, what's the loan term, is it a 30-year fix, is it a 15-year fix? What's your LTV? There's a lot of different factors that play into what your mortgage interest rate will be.
All right. Well, thank you for those updates. What have you been seeing the mortgage rates do this week? Because I think that after the news of Moderna came out, and I know we're going to talk about a lot more in the lower interest rate section, but I know that when that Moderna news came out, there was initially, it looked like a dip and then an increase again this week alone.
Yeah, so the Moderna news came out on Monday. And for those of you who are like, what in the world is Moderna? That is a bio firm who is developing a vaccine for COVID-19. And they released some really positive news on Monday, basically stating that they've done phase 1 of human trials, and they had about 45 participants in this trial. And, they got really positive news about the participants developing antibodies and potentially, getting into phase 2 and then phase 3 of human trials as early as July. And they were a little bold and said, hey, we think we can bring a vaccine to market early 2021. So, stocks kind of soared on Monday, and bonds, didn't do as well. So we saw a little bit of an increase in mortgage interest rates, probably by about an eighth or so. So it wasn't like a swing in interest rates, but there was a small increase in interest rates. So we saw that happen. And, later throughout the week, we did see interest rates, level out and come back down. And today we're kind of just flat.
Okay. Well, thank you for those updates. Let's go ahead and move on to the next topic, which is the mortgage market update, specifically about mortgage forbearance guidelines. What can you tell us about this? Because this is something that's changing almost daily.
Yeah. So last week, our topic was forbearance gone wild. And it really had gone wild because there was so much miscommunication and misinformation out there. And it was really hard for people to decide if forbearance was a good option for them or not. Well, this week, I believe it was Tuesday, FHFA came out with some really good information and updates about mortgage forbearance. So you can see, Andrew just pulled up an article here that, just goes over what happened on Tuesday. But basically, FHFA said anyone who entered into a forbearance plan by mistake or intentionally, but maybe they made their mortgage payments on time, even though they were in the forbearance plan, there's no penalty to you. As long as you made the payments on time, you should be able to refinance your home loan or purchase a new home with no waiting period. Now, if you entered into a forbearance plan and you skipped the mortgage payment, there's going to be a little bit of a waiting period once your forbearance period ends and, you get current with whatever plan that you choose, whatever option for mortgage relief that you choose with your loan servicer. Once you make 3 consecutive on-time payments, you will be eligible to refinance your home loan or purchase a new home. And this is so much better because we thought that the waiting period was going to be 12 months, and now we're learning it's only 3 months. So this will help so many people, get back into the game to be able to take advantage of the historically low interest rates that we're seeing today.
Well, thank you for those updates, because that was pretty interesting. Because initially, when we were talking about everything forbearance last week, from credit card use to mortgages to auto loans and student loan deferrals and forbearances, it sounded like that was going to negatively impact anybody, even if it was done on mistake. So now this reversal of the situation with more guidance coming out is super, super amazing, especially with the news that with 3 consecutive on-time payments, then even if you were in forbearance, you could still qualify to refinance your mortgage and take advantage of these historically low interest rates, which actually brings us up into your next topic. It's all about the lower interest rates. So tell us, are we going to be seeing like sub 3% interest rates, do you think?
Andrew, every week I get at least 4 or 5 people asking me, Celeste, should I wait to refinance my home loan? Should I wait to purchase? Do you think interest rates are going to get lower than they already are? And the truth is that we don't really know. We can't really predict. It's really hard to predict where mortgage interest rates will go. But experts do predict interest rates to stay low for the foreseeable future. But a lot of experts are saying we may not see another drop in interest rates. They're really predicting interest rates to kind of stay in the range that they're in right now. So the next question you should be asking is, what affects mortgage interest rates? What causes mortgage interest rates to move? And really, there's a variety of factors that go into the movement of mortgage interest rates. We're looking at current economic conditions, the Fed's monetary policy. We're looking at inflation. We're looking at news that comes out from the media or any statements that political leaders are making, news about a potential vaccine coming out or treatment for the COVID-19 virus. So, it's hard to predict what's really going to happen with the virus or with the state of the economy when we don't have all of the information right now. So in reality, it's really hard to predict exactly where interest rates are going to go in the future. So here's just, an example of what I see, driving interest rates right now. And we just talked about it, the Moderna information that came out from Moderna on Monday, any information regarding a vaccine or positive data from human trials, can alter interest rates. If investors see that, a potential vaccine or treatment could come out, they may think that our current economic conditions can change in a more favorable direction. And, that can cause interest rates to go up. But, we also saw later this week that there were a lot of other bio firms and vaccine experts that came out and said, hey, we don't really trust the validity of the information that Moderna released on Monday. We don't really think that they were providing enough data to really tell us if we're going to have a vaccine as current as, January 2021. They think it's going to take a lot longer. So that definitely caused mixed feelings within the market. And I think maybe that could be a reason why the Moderna stock kind of went down a little bit since Monday, and a reason why, mortgage interest rates and bonds started to improve throughout the week.
Awesome. Thank you so much for that, Celeste. And so you were talking about a lot of different things with the lower interest rates, and you gave us a list. I know that you sent me a list of the different things that you were watching right now about what affects mortgage interest rates. And you were saying, hey, it really boils down to like economic conditions, the Fed's monetary policy, the inflation rate at the time. Obviously, the unemployment rate is extremely significant. And interestingly enough, even opinions and misleading information, such as any kind of statements made by a political leader or media outlets, can actually have an impact because it stokes consumer confidence or takes away from consumer confidence, and also that of the investors. And depending on how they interpret that information, they can shift one way or the other. So I thought that was an interesting one that you put up there, because it is very valid and something that we do need to take stock of, the reality of just how much a misinformation piece can actually turn the tide, even if it's fake. So
exactly.
You were talking about the state of the bond market and the housing market, and the list does go on. So I really appreciate you letting us know what was driving the mortgage rates currently being with the Fed. And you were starting to go into it a bit with like what the Fed is saying, and they don't set the mortgage interest rates was a very important comment, I believe, that you wanted to share.
So, the Fed, I've been talking about this a lot on our live channel. I talked about it 2 weeks ago. I talked about it last week. It's no secret, the Fed is pumping money into mortgage-backed securities. They are committed to keeping interest rates low. And really, the Fed doesn't set mortgage interest rates. So I want to make that really clear, because people get confused when they're like, oh my gosh, the Fed lowered the Fed funds rate to 0%. Right. And I got a ton of calls, and people were like, oh my God, I want to lock in that 0% interest rate. And, I had to kindly inform them that the Fed does not set mortgage interest rates. The Fed funds rate affects short-term rates, and fixed mortgage interest rates are long-term rates. So, the Fed lowering the Fed funds rate to 0% doesn't directly impact mortgage interest rates, but it can indirectly impact mortgage interest rates. But what we really saw impact mortgage interest rates is the Fed purchasing mortgage-backed securities. And today, I believe they purchased around $4.5 billion in mortgage-backed securities. And that's what's keeping, bonds up and bond prices high and interest rates low. And the Fed said that they're really committed to keeping the mortgage market stable and interest rates low, because that's what's really stimulating the housing market, and in return, stimulating the economy. So that's why a lot of experts are predicting interest rates to remain low for the foreseeable future.
Yeah. And then the number thing, and thank you for that, Celeste. And the number two thing was like the Moderna vaccine information for coronavirus. Time will tell, ultimately, once that starts going into testing and peer review and making sure that everything was on the up and up. So, where you might get an upswing if it pans out and it's true, then that's actually excellent news. But if the opposite is true, then obviously we could see a dip and some hard-hitting information coming out that won't exactly be positive at that time. So I think that's worth mentioning and watching at the same time, being realistic with what's happening there. So Celeste, before we get into the viewer Q&A, I know you shared with me that you had a Celeste tip of the day.
I do have a tip of the day. So, a lot of first-time home buyers come to me and they have their down payment savings, they have their closing cost savings, they think they're all ready to go and purchase a home, and they are. But I always recommend to have an emergency savings fund or a savings fund for home maintenance, because a lot of people forget that, once you own a home, you're responsible for anything that needs to be fixed or replaced. So it's always recommended to have an emergency fund or home maintenance fund that you can dip into should you have a rainy day.
Thank you for that, Celeste. That's very good information to know. And for reference, when we're talking about emergency funds, I've made different videos on my YouTube channel about savings and how to save up for emergency funds. Typically, the ideal goal here is that you would like to have anywhere between 3 months and 6 months of how much it costs every month for you to live. including like rent, mortgage, food, gas, anything and everything that you need in reserve. Now, a lot of Americans unfortunately don't have that. So that's a goal that we should all strive to, is that minimum of a 3-month emergency fund and keep growing it. When you're talking about housing savings for maintenance and things to do with homes and incidentals and such, the best practice there is to at least save 1% of your home value. So if you're saving 1% of your home's value, let's say that you have a $300,000 home, right? With a $300,000 home, that means that you would ideally want to save $3,000 a year. Now, sometimes people say, hey, Andrew, does that mean that I am going to have to pay $3,000 a year to maintain my home? No, it doesn't. But it does mean that if something big went out on your house, let's say something that a home warranty didn't cover, let's say something that your homeowner's insurance maybe doesn't cover, like maybe a new roof, maybe you need to replace the roof. Over time and practice of building up that account, you'd have a separate fund in addition to your emergency fund for your home fund. And if it turns out that your home is new and you're doing a great job maintaining it, guess what you can do? You can invest in the renovations or go take a vacation with some of that money if it proves that you don't need it. Just don't blow it all and keep those savings there. But in time, once that account builds up, you'll have options. Invest it, do whatever you want to do with it. And there's a lot of great opportunity there. So let's go ahead and get into our fun part. The part I always look forward to the most personally is connecting with our tribe and seeing what's on everybody's mind. I've seen some comments coming in. So thank you everyone for your patience. And if you're joining us just now after the live stream, thank you for being here. I really appreciate it. And to everyone that is live with us, thank you so much. So before we dive in, and I know that Nicoletta probably wasn't able to join us today, but Nicoletta was hitting me up on Facebook Messenger yesterday. Now, Nicoletta and her family are actually in the closing process right now. And she said, Andrew, I don't know if I'm going to be able to make tomorrow's live, but I wanted to ask this question. And it was really interesting. She has a very well-paying job. She is a medical professional. But earlier this year, she was out on a surgery and her income dropped. She was getting paid, but her income dropped during that surgery and recovery period, and her tax returns were a little bit off. And she was concerned and was asking the question, how is that going to impact me in final underwriting? And I said, let's bring that to Celeste. So I sent it over the message to you. And what would you tell Nicoletta when she watches this later on?
Yeah. So, hey, Nicoletta, that is a really great question. And I actually run into a lot of home buyers who have similar situations. And it's really case by case. It really depends on how long were you out of work? Was it just a month or was it 8 months? That's going to make a big difference. Also, underwriting is going to look at, your work history. So if you've been with the same employer for 5 years, they can look back and say, oh, look, her income's been pretty consistent for 5 years. She's a medical professional. Her job is in demand right now, basically. And unfortunately, she had to have this surgery. She was going through a tough time and had to take time off work. Because most medical professionals, as we know, they work on their feet and they work in a very fast-paced environment. So if you've just had surgery, it's common sense to know that, you're going to have to take some time off from that job. So typically, what I see underwriting asking for in this situation is usually a letter of explanation, just stating what happened, what was the circumstance, and sometimes, maybe they'll take a look at more than a 2-year work history. Maybe they'll start looking at 3 years instead of 2 years to supplement that gap, just depending on how large that gap is. But if your income is pretty consistent, I don't think underwriting will penalize you because you had a surgery.
Yeah. And pretty much when I was going back and forth with her, I said, look, one of the best things that you can do is share this with your loan officer that you're working with. Now, with that said, because she's on the East Coast, right? And then I shared with her, I said, look, we gotta remember, number one, we're hashtag stronger and better together than we are not. And then we also got to remember we need to move beyond hashtag fear, where we got fear being false evidence appearing real. And what provokes anxiety in the closing process that I see in real estate practice most commonly is the fear of the unknown. And that's why I call it the false evidence appearing real. Because if you don't know what it is or what the outcome is of a situation, are you not then just telling yourself this song and dance of the story in your head and you're starting to worry about stuff? And that's where my country boy ways say, hey, that's like crying out about spilt milk when the milk ain't even left a cow yet. How can you cry about milk if it hasn't left a cow? So let's go over there to the barn and let's go ahead and milk that cow and see what's up, right? So
Super country.
super country. Well, I did grow up on a farm. I'm just saying, right? Yeah, country is country. Get it? Don't let me fool you. So that said, it's the truth. And she felt better after that. And I said, look, at the end of the day, a solid loan officer would have, when they were giving you your pre-approval and vetting all your information, would have seen the discrepancy and probably has already asked or probably already known about the situation. And it could fall underneath what's called a mitigating or extenuating circumstance. To your point, a simple letter of explanation. So I'm waiting to hear back from Nicoletta after she has a chance to talk to her loan officer, but I'm pretty confident that everything's going to be just fine for her. So my friend, when you watch this later on, thank you for the great question. We're always here for you, and I appreciate you and your support. Now, Nathan had asked a comment before the live. He started making a couple of comments, and Nathan, thank you for joining in and being with us today and for your patience. So Nathan said, I think there will be lower mortgage interest rates, possibly a chance for people to refinance if we have negative interest rates on savings and checking accounts. Then he says, thanks for your video. I think we will need a negative 10-year treasury note for the interest rates on 30-year mortgages to reach the low to mid twos. So obviously I have a lot of different thoughts and considerations on this, but as opposed to me saying it, why don't you as a loan officer go ahead and tackle that?
Okay, Nathan. So, there's a lot that affects interest rates than just, following the bond and treasury notes. Sometimes interest rates will follow these trends, but sometimes they don't. And we saw that in March when, early March, interest rates dipped really low and we hit what I call a refinance boom. And there was so many refinances coming in that mortgage lenders hit capacity. And when mortgage lenders hit capacity, then the fears of, this potential virus or pandemic coming to light started to happen as well. And we saw all kinds of issues with margin calls. Lenders were having margin calls. There was volatility. So lenders were doing risk-based pricing. And we saw interest rates get wacky. I mean, we saw them go really low and maybe one day they were in the threes, the next day they were in the fours, some lenders were quoting in the fives, so it was all over the place. So just because the 10-year is moving in one direction or bonds are moving in another direction, it doesn't always correlate with mortgage interest rates. So this is the point I really wanted to make. I should have made a little bit earlier during our live stream, is that you can sit on the sidelines waiting for a better interest rate that may not materialize, or you can just take advantage of the historically low interest rates that are available to you right now. Because if you wait on the sidelines, you can most definitely miss a really great opportunity to purchase with a low interest rate or refinance to a lower interest rate to save money.
I think those are great points. And I also think it's worth noting that if we talk about interest rates going negative in this case, that's not a good thing, because if you go negative, how are these institutions making money? If they're not making money, then long-term potential and horizon on that is not good at all. So when you start looking at people's checking and savings account, why the heck would we ever want that to go negative? So essentially we got to pay the bank to have our money in it. That's not cool. So when you start looking at these things and starting to get sub threes and talking about maybe low to mid twos, look, if it happens, it happens. But at the end of the day, it's not something that honestly, as a consumer, when we take a step back and hashtag JTAB, just take a breath, right, to reassess the situation, it's not something that we realistically would like to see for the health of the economy and for taking care of each other. It's just the reality of a situation. It's not about being greedy. It's about being here and stronger and better together than we are not. And understanding that we need to focus on what's good for not only ourselves, but our neighbor, our fellow human being in our community and our country, and come together, because we, the people, are always stronger than we are not. So let's move on, because that's going to bring us into some of these other questions that I saw coming back. So thank you so much. XXYY says, hi, Andrew, is it better to have a low interest rate with current house prices, or is it better to have higher interest rate and lower house prices? Thanks. So XXYY, thank you so much for joining in, and I really appreciate the question. There is a lot going on with some of these questions, and I recognize a lot of names, obviously, in the people that are tuning in live, and thank you for that. I really appreciate how strong our tribe is, and keep pushing the word out to get more people knowledgeable about what's going on. And the reason I say that is some of the times somebody asks me a question and they think it's a really quick answer, and it's not, because there's a lot of variables going into it. And the reality of answering questions from like a real estate perspective and a lending perspective in the truth is sometimes a yes, no, and maybe so answer. It's yes for a reason, it's a maybe so for a reason, and it's a no for another. So when we're talking about, is it better to have a low interest rate with current house prices? The answer is yes. And the reason being is this: there's a lot of fear pushers out there that are trying to say that foreclosures are going to be raining down on us over the next, 24 months or less, if not in the next 6 months. It's just not the case. For the reasons that Celeste and I were talking about last week, and how many people are homeowners in the country, how many people have equity in their home, and how many of the homeowners actually have a paid off mortgage. So then you have mortgage forbearance options. Now, Celeste gave us the updates about how forbearance is working. You can still do a refinance. There's so many different options. Then you have a loan deferral. Then you have loan modification programs. There are so many ways to prevent that from happening. And ultimately, if somebody did get foreclosed on, is it going to be sufficient enough to truly impact the market when in January of this year alone, we were coming into the year at historic lows with foreclosure rates hovering around 1%. Now, when I got into real estate in late 2013, our Las Vegas marketplace consisted of over 50% foreclosures and distressed property sales from short sales and stuff. Definitely don't see that one happening again. And after 2008, we had all these legislative passages underneath President Obama with the Dodd-Frank Act, with the formation of this Consumer Financial Protection Bureau, with tightening lending guidelines, with more regulation, with ensuring that borrowers actually had to meet the mustard to purchase a home. So that's why I don't see the market just diving down. If our home prices were to go down, I think they might only go down somewhere between 2% and 5%, which in the reality of real estate in a 12-month cycle is not much, because the next cycle you're probably about to make it up and then make it up more. So when we're talking about the timing of a purchase, it really comes down to the reason that you want to purchase, for the reasons that are important to you, and for the reasons that make sense to you at the time in your life that you're making that purchase. Because the market will be the market will be the market. Markets will go up, they'll go down, and they'll all go all around. The one thing that doesn't ever change is the fact that we as people need shelter, food, and water. So when it comes to shelter, you can choose to rent that roof, or you can choose to own that roof. But ultimately, it's your decision. The only caveat to that I would share with you is if you're concerned about your job security. If you think there's a potential furlough, or you might be getting laid off in the future, and I'm talking about in the near-term future, not like, oh my God, what if? Let's not play Chicken Little. This guy's not falling down. I'm talking about if you got a real concern here that in the next 3 to 6 months or something, you may not have a job. In that case, don't buy. That's the only time I'm going to tell you that, because if you have good job security, then take advantage of the present market, because it's not going to last forever. I've seen more in real estate practice. I'm seeing sellers being more open-minded to some seller concessions in the form of paying some buyer closing costs or reducing their price a bit. That typically hasn't happened too much, frankly, over the last 2 to 3 years. So there's an opportunity there for those that it makes sense to purchase now. So I'm asking you to just take a step back and reassess the overall situation, gain clarity on the reasons why it's important to you to purchase a home, and focus on those meaningful life advancements to you. So when you talk about higher interest rates and lower house prices in the future, again, I don't see that happening. There's been study after study after study and report after report after report coming out right now that home prices are not tanking. They're actually holding very, very stable. And this is as recent as watching what just happened in April. Now we're going to get the May news. In early June, we'll get the May report. But we already got the April report. And the April report, in the thick of everybody being quarantined, you had less homes going on the market. So you see these headlines where it says, hey, home sales are declining. Yes, but what's the word? Home sales, not value. There's the difference. Home sales went down for obvious reasons with COVID-19, people being concerned about, hey, if I go look at a home, am I going to contract COVID? Oh my God, there's all these furloughs going on. Oh my God, what's happening? So people had to take that step back. They had to gain clarity and they had to reassess the situation for facts, right? But there was also a lot of families that I was working with, and Celeste and Bill Marin were doing the same to help people buy homes that were ready. And they said, hey, this is just the right time for us. And whatever's happening, it's the right time for us. We'll be smart when we go showing. I was just showing homes the other day. I have my little mask on, and I even put my medical gloves on. And that's how we show homes. That's a COVID-19 way right now until we get a vaccine or we're in the all clear. Everybody should be wearing masks. And when you go into other people's home, you never know. And you got to be safe and take care of each other. It's just about using a little bit of common sense there. So I don't necessarily think that the prices are going to dip. And if they do dip XXYY, how are we not so sure that the interest rates didn't go up? And now you're at a trade-off of an opportunity cost of time right now, if it does make sense. And you're now employing a tactic or a principle called time value of money and making a smart decision moving forward. Because if you speculate, then what happens if you speculate wrong? Whereas if you go ahead and get yourself in the home ownership now, if the time makes sense, then you have an opportunity to start beginning to build equity. As a homeowner, you're going to see your equity go up, down, and all around. But overall, on the historic average, you'll always see it go up. You're going to take a hit sometimes, and you're going to go up a lot sometimes. So it's one of those situations that over time it bounces off, and it normally bounces in your favor. So long story short here, please gain clarity on the reasons why you want to purchase. Assess your job security. Assess the timing in your life. And if it makes sense, there's your answer, right? So Sally Gariba essentially asking the same type of question. Hey, is now the right time to buy? Thank you, Sally. I hope that what I just shared was sufficient. But if you have a follow-on question for us, please let me know. Kathy Martinelli says, hello, tribe. And Kathy, thank you so much for joining us. I love it. Yes, we got this wonderful tribe of growing of almost up to 20,000 coming up pretty quick, of 20,000 tribes peoples with us. We got to name that tribe, Kathy. We got to think of a good name for us. So if you can think of one or anyone else can think of one, let's come up with a name, and then let's start making even like a side community where I can give you even more information and like downloadable formats and stuff like that. That could be very helpful for you guys moving forward. But to do that, I'd really like to have established a tribe name. So anybody that can think about that, please let me know. Drew's Enthused. Hey, welcome back. Well, welcome back, my friend. Celeste, I wasn't sure if you were able to see us on Monday with Bill, but Drew's was actually on the screen with us. It was
really?
Yeah, it was super exciting. He just closed on his and his fiance's new home in Phoenix, and he wanted to share the great news with us, and it was so much fun. He actually has a YouTube channel of the same name, Drew's Enthused. His passion is about mountain biking and having some fun stuff. It was a pretty cool channel. I was checking it out, so it was a lot of fun. So
yeah,
Drew,
congrats, Drew. I'll definitely have to check that out. This has been a crazy week. You know, I definitely saw an uptick in business this week, so I didn't get a chance to check out the live, but I will this weekend.
Awesome. Thank you so much. Definitely appreciate you being here. Claudia says, good morning. Love it. Good morning, Miss Claudia. Thank you for being here, my friend. Definitely very much appreciated. We have Norm Grunsfield says, good stuff here. Norm, I'm glad that you're enjoying the content. If you have any questions or you want to pop up with us, the link to pop up on the screen with us is in the show more description. Anna A says, hi. Anna A, I have been seeing more and more comments coming from you recently, my friend. And I just want to say thank you. I really appreciate your kind words and your support. Anna's been watching a lot of the Hernandez family's reality show, which, by the way, is freaking awesome. We just went through episode 6. Next week is episode 7. It's a 14-part series about literally all the details in home buying, in as much as I could practically share with somebody what it really looks like to buy a home, not the sexy, well, some parts might be sexy. But I mean, the point that I'm making is it's not like hyper glamorized and made to look like it's the easiest thing in the world, even though it can be easy, but actually covering all the details of what it takes to buy. And the idea and the premise was every life has a story. Let's share that story with the families that are on with us. And then let's show how real estate is just one part of somebody's book of life and a chapter moving forward in the right direction for them. So it's a lot of fun. But Anna, thank you for being here, my friend. Greatly appreciated. Anthony Santos, thank you so much for joining in. Anthony says, I just refinanced recently for 3.25%. I wonder if I should refinance again. Thoughts?
Anthony, that's a really great interest rate. And, every time you refinance it, it does cost money to refinance. I think, it would probably be in your best interest to just keep that interest rate for a while, because you never know when you might need to refinance again in the future. And you don't want to be refinancing, every 6 months or every other year. Because again, it does cost money to refinance.
It does. You still have buyer closing costs on refinances. The reason that sometimes borrowers and people that are refinancing don't realize that is because all too often the lender's just rolling it onto the backside of your loan. And if you're not paying attention or looking at your closing disclosures and your loan estimates on the beginning of the process, then you're not really paying attention because you're focused on the rate and not focused on what the trade-off is with those closing costs. You still have them. So it's important to take stock of that. And that's why I made videos about like the beginner's guide to refinancing and when it's a good idea to refinance and all kinds of different refinance topics to help people ask the right questions.
Exactly. Yeah. And it's definitely something that you'd want to sit down with your lender and kind of pencil it out, figure out the savings. If you're in a 30-year fix and you're looking to get into maybe like a 15-year fix. I mean, it really just depends on your specific situation, but that's a great interest rate for a fixed mortgage loan. And I personally, if it were me, I probably wouldn't touch it.
Yeah. And I actually have that same rate, to be honest with you, Anthony, at 3.25, and I've had it for 4 years. And even with some of the rates that, I was talking to Bill about it, he's like, if you bought like a point or two, you can actually probably get down to like a 2.875. And I said, what's the monthly mortgage? He told me the monthly mortgage. I did my math on it against the buyer closing cost. I said, this is going to be like an 8-year break even point. I said, for what I'm going to save. And it doesn't make sense because over the last 4.5 years on my mortgage, between additional payments and normal mortgage payments, I put over $100,000 onto my overall balance of my mortgage. Guess what? I don't want to lose that over maybe saving $150 a month. It's just not worth it at the end of the day. Now, if you told me you could save me like $1,000 a month on my mortgage, I'm going to be, hey, let's rock on, dude. Let's take a look, but not at a 30. Let's take a look at maybe a 15 and see if that's going to be something I can bite on. But I mean, it's all the same. These are the considerations that sometimes people see the rate and they always think, oh my God, I just saw a rate and it said 2.5%, but on what terms? With what credit score? With what minimum investment, what cost, and was it an adjustable rate mortgage or was it a 15-year fixed? And can you handle the 15-year fixed rate mortgage payment? Because normally those are a little bit higher. So, I mean, you got to really get clear on these questions before you make a decision. But I think it's a really good question, Anthony, and I appreciate you bringing it up. Because if you're thinking that, I know millions of other Americans are probably wondering the same thing. So thank you for having the courage to make that question.
Yeah, Andrew, it's funny you mentioned that, people are surfing online and seeing all these attractive interest rates. And I know we were chatting about this earlier today.
It's right there.
Yes,
it's right there.
Yes, there it is. We were just talking about this. And, when they price these interest rates online, usually somewhere in really, really small print, it'll tell you what the terms are. It'll say, is it a 15-year fix? What does the LTV have to be? What's the DTI? What state is it in? Sometimes it'll say this interest rate is based on, interest rates for the state of Washington, and you might be in Oklahoma and, you might have a different credit score than what is required to get that particular interest rate. And oftentimes when they're posting these interest rates online, they're usually quoting them with, usually paying a point or two. So it's really important to not just look at what's being offered online and to actually reach out to a loan officer and find out, what are the qualifications to get this particular interest rate, because it can be very misleading when they post it like that online, and then somewhere on the page in really small print, it has all of the qualifications to get that particular interest rate.
And that's exactly right. And I try to blow this page up so everybody can see it a little bit clearer, but right there, and there's always one of these things where it says terms and conditions apply. You must have an 800 plus credit score, assuming that you have at least 20 to 25% equity in your property to refinance at this rate. and it'll cost you 2 discount points and blah, 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 blah. So, I mean, that's the reality. I've shown that before to buyers again and again and again. When you start taking a look at things, it's the reality. And it's important to gain clarity on the reality. And that's why I always ask people where I come up with these hashtag movements, essentially like hashtag data, just take a breath to reassess. If we don't get anxious, the best way to prevent anxiety is taking deep breaths in and getting oxygen into our brain and relaxing our body as the oxygen goes throughout our body, right? It's just science. I mean, it's proven this is how it works. Normally when people feel anxious, it's because they're forgetting to breathe. So that's why I say hashtag JTAP. So you get too excited about seeing something salacious, and then you get that little FOMO like, oh my God, I'm going to miss out if I don't take advantage of it, but you're not calculating the cost. And that's where I've been more recently sharing with everybody, every coin has 3 sides. You got an extreme on one side. You oftentimes have a polarized extreme on the opposite, but in the middle, the third side of the coin, often overlooked, that's where the truth resides. And that's what I'm asking you to gain clarity on, Anthony, and everybody that's watching us hereafter. Darren, it has been a while, my friend. Oh my God, dude. I am so glad that you joined us. Maybe he's been joining us, Darren. Maybe you've been joining us for quite some time. But Darren goes back as one of our tribe's folk for years. And they closed, I want to say, a year or two ago on their home after watching the channel for a year or two. So he's been with us for a minute. So Darren, definitely thank you. It's great to hear from you, my friend. And Darren is saying we have both, referring to an emergency fund somewhat and a Sears home warranty. And right now it's kind of tough to say when you're using it during this time. You're right. And Darren, that's the whole point of having the emergency fund. The emergency fund ideally just keeps growing, yes. But the point of having an emergency fund is to help float us in the hard times of life. And good on you, my friend. Massive kudos to you. I mean, I just give you a big old bro hug if I could, because good on you that you have it, because you're not sweating the bullets as hard as somebody that has nothing, because they didn't save, because different impacts, different things impact different people the way that they can or can't save. Some people truly just don't make a whole lot of money and they're on paycheck to paycheck, and it's just because their income's low. Other people make good income and they choose not to save because they choose to buy toys and go out dining all the time, and that's very much their fault, and not being disciplined and balanced in their approach. And that's just being honest. Now, Darren, you've done everything right. And I do recall quite a bit of your situation from our prior conversations. And my friend, I am glad to hear that you have it. Keep doing the best that you can to save. And just know that your emergency fund is now serving you for the same reason that we need one to begin with. So I'm so super happy to know that you have one. Anna, thank you so much, my friend. Anna says, is it true that rates being so low right now, it's good short-term, but it's negative for long-term future loans? Celeste, thoughts?
So it's true that with rates being so low right now, it's good short term, but it's negative for long-term future loans. So like I said, it's really hard to time the market. If we're going to sit around and think that mortgage interest rates are going to move lower, the truth is we just don't know. And it all really depends on what happens with economic conditions, what the Fed monetary policy is like, also, inflation. So we have to keep an eye on a lot of these things, plus the state of the bond market. And like I said, there's so many different factors. It's really hard to tell exactly where interest rates are going to go in the future. But like I said, experts, they're projecting interest rates to be low for the foreseeable future because they really believe that the housing market is something that's going to help stimulate our economy and bring us back to life.
Mm-hmm. And I think that's a really good question. That is like so deep, and it would be so fun to have like economist on and talking about this with you, because the reason being is this. And this is where we have a double-edged sword in the United States with real estate. And when we look at home appreciation and stuff, mortgage interest rates held down for too long. Right now, they're artificially suppressed, and everybody should be realizing it. They were artificially being suppressed before COVID. But now you have a big artificial suppression with the government investment into mortgage-backed securities that are propping it up and then cutting the Fed's rate policy, which I don't believe it's ever seen that, at 0 to 0.25%, lowering, in other words, the cost that lenders can borrow from and then assigning a rate thereafter. Look, at the end of the day, if rates are too low, what does that do to home appreciation? Essentially leaves it unchecked in the wake of high buyer demand. Now, what happens if rates were where they should have been coming in this year around 5%, 6%. And anyone that's watched like my prediction videos from 2018, 2019, and 2020 would understand just how deep I go into this and how far back I do and how deep I dive into that research. The reason I say that is if the rates were up around 5% right now, it would cost more to get a home. Your mortgage would be higher, but your trade-off is you would have more balanced home appreciation, if not a correction of prices, because it would pull back buyer demand based upon qualification. And if supply stayed roughly the same, supply here being homes, then what we would see is a correcting market. Because even in today's market, nationwide, I was just reading a report this morning, 4.1 months of home inventory is all that's left right now. And that sounds like, oh my God, that's a lot of homes. Yes and no. And no, because a stable market is considered to have 6 to 7 months of home supply. And we have not been at that point in a long time. So the important thing about the 4.1 marker is just last month, in the deep of everybody being quarantined, we were at 4.2. So when people are saying, oh my God, there's just going to be this glut of homes coming on the market and it's going to tank everything and buyers aren't going to buy, it's not what we're seeing in practice in lending or in real estate. It's not realistic. And that's where I keep trying to share with everyone. And I hope time proves it correct, that what I'm sharing with you with great loan officers like Celeste Harvey and Bill Marion and Addison Nett that was on with us previously, and the other top agents that have joined us on these live streams, is the truth and the reality. And we're trying to guide you. You know, anything can change, anything can bounce one way or another. And the best way to stay on top of it is going live. But we have to be honest about what's going on. So ultimately, Anna, if the rates are going to stay low, it's good for home buyers to take advantage of it. There's no question about it. But if the rates do go higher, then at some point, you're going to also see real estate prices have to balance in line to the new reality of a higher interest rate and see what's happening. And I believe that a lot of us, we get so fixated on our life and growing and developing like we have been since the collapse, right? But it's important to realize that in 2006, 2007, rates were, I believe, around 7 to 9%. And if you could get like a 6% rate or a 7% rate back then, you were doing good. And that was the norm. So it's just important to put in context how high interest rates have been, where we are now, and how long they've been at this low. I don't believe any time in American history, when I did the research, have rates hovered under 4% for over a decade. Just saying. Okay. So Bill Marion says, great job, Celeste. Pow.
Hey, Bill, what's up? For those of you who don't know, here's a little fun fact. Bill, I actually used to be on his team back in the day, and he was the one who helped me get my foot in the door in the mortgage industry. So thank you, Bill. Miss you and Emma. Hope you guys are doing great and kicking butt.
Absolutely. And thanks, Bill, for joining in. It's always great to hear from you, my friend. Norm, thank you for the question. Norm says, what's the best rate you've seen on conforming 30-year loans recently? No points. Celeste, what have you seen for a conforming loan amount? And by the way, conforming loan amounts, everybody, is under 510, 400. I know this 510, 400 number because Bill keeps putting it in my head.
Yeah, you know, I've actually been doing a lot of conforming loans lately, refis and purchases. And back in early March, you know, I locked in a refi, conventional 30-year fixed at 3%, and we closed that one in April. You know, I locked in another one yesterday at 3.25%, and I'm looking at locking another one today at around 3.49%. So again, in the low to mid threes is kind of where we're seeing the interest rates, and it all fluctuates. It's going to depend on your loan to value, your credit score, your specific qualifications. So, you know, kind of that range of interest rates, you know, has a lot to do with the loan to value.
And I think it's important to also note and add into that layer is what type of loan are you getting? Obviously, if you're using a down payment assistance program, you're boom, gone. Is the idea, notion of that low of a rate, because the down payment assistance program, by virtue of providing the down payment assistant, must charge a higher rate to pay for the program. So it's a very real consideration, and one that I've shared in a lot of videos on my channel, and also in practice a lot with people saying, hey, what's the difference between what is euphemistically or a sexy wording called first-time homebuyer loans, when in reality it's just a bait and switch to say, hey, this is for you. You're a first-time home buyer. Come and get this, and we'll give you some down payment assistance. Yes, but at what cost? It goes back to the refinance conversation earlier. It's important to understand and weigh the risk versus the return and the risk versus reward when consideration. So it sounded like, to answer Norm's question, though, you'd seen 3% at the lowest, and more recently, maybe a 3.49. So
yeah, but VA loans and FHA loans typically have lower interest rates than conventional loans. So with those, sometimes you can see it dip into the high twos, low threes. So, but again, it always comes back to what Andrew said. What type of loan is it? Down payment assistance, or is it just a regular 30 fixed FHA, VA, or conventional loan? And what is your loan to value? What is your credit score? What is your debt to income ratio? What are your specific qualifications? Because that is really going to dictate what your interest rate is based on the current market.
You're absolutely right. So Michael, thank you so much for joining in, Michael. Michael says, currently shopping for a home right now in Southern California. After getting pre-qualified, if interest rates go down before closing, do all lenders accommodate the rate drop or just specific lenders?
From what I'm seeing, most lenders, if your interest rate's not locked in and interest rates go down before closing, then obviously you can lock in at that interest rate. But if you're locked in to a specific interest rate, most likely most lenders are not going to reprice your interest rate unless it's dropped significantly. It would have to be, a significant decrease in interest rates, which I don't really see happening for the foreseeable future. So again, talk to your loan officer, see what their specific policies are that their company has in place. But most likely, once that interest rate is locked in, that's the interest rate that you're going to get.
Okay, good stuff. Thank you for that. Kathy Martinelli, thank you so much, my friend. She's saying, Andrew, is it worth refinancing if you plan to pay off your mortgage in 10 years? In my humble opinion, unless there's a huge difference in the rate and you're doing that refinance in the first 3 years, the answer is no. Because if you're planning on paying a mortgage off in 10 years, that means that you're already hitting your principal hard and go ahead and knocking back the interest clock on your amortization schedule. And the cost of refinance, let's say, typically, let's say it's 3% just for easy math. Let's say you bought a $500,000 home and you intend to pay it off in 10 years. So you're throwing down on that bad boy like 50, 60 G's a year, right? Well, it's going to cost you $15,000 for the refinance alone. And if it's only going to save you, let's say $100 a month, right, from the refi, which would be reasonable. Let's even be more friendly to it and say it's going to save you $200 a month, right? $2,400 a year over 10 years, right? $24,000. So if you're following my math real quick, that's $39,000 of opportunity cost for the refinance for the potential savings, but yet you're throwing down at a $50,000, $60,000 a year level for the case of this example. Your mortgage is done by the time you hit your break even. It's not anywhere close. So if you have a rate that's comfortable and you're comfortable with your repayment structure and you actually have like maybe one of those 3.5% rates, keep throwing down and keep going at that principal hardcore because you don't want to reset that clock. So that's my assessment, because I'm right there with you. And that's what I was telling Bill whenever he and I talked about potentially refinancing my home loan, which is a VA loan, and using the VA interest rate reduction loan when you go back to the types of loans there, Celeste, and how you can get some of these really interestingly low rates. There's special programs, depends on the borrower's credibility, their economic profile, their financial considerations, debt to income ratios, credit scores, all that fun stuff, right? But the point that I'm making is even with that interest rate reduction loan for a VA home loan, it doesn't make sense. It just doesn't make sense because it literally saves me like $150 a month and takes 8 years to hit the break-even point. Well, in the next 8 years, I hope to have this mortgage paid off, if not sooner. So it doesn't make any sense. So I hope that's helpful to you, my friend. Let us track back on that. And if you want to share some of the tips that you're using to pay off your mortgage in 10 years, please hit me up directly and let's get it out there and share it with other people too, so they know how to do that. Hugo G, thank you for joining in, Hugo G. Hugo says, good afternoon. 2 months ago, I requested forbearance and I was approved for it. After a month, I decided to call the bank back and cancel the forbearance. Can I refinance in the case I need it?
Good question, Hugo. So we touched on this topic a little bit. So when you call the bank back and you cancel the forbearance, it really just depends, did you actually skip any payments? If you entered forbearance and you didn't skip any payments, you're eligible for a new refinance or a new home purchase right away. There's no penalty, there's no waiting period. Now, if you entered the forbearance and you skipped a payment, well, now you got to get with your loan servicer, figure out which plan works for you. If it's getting current all at once in a lump sum, are you going on a repayment plan? Are they doing a loan modification? You got to hash that out with your servicer and figure out what works best for you. And then you have to make 3 consecutive monthly payments on time. Once you've done that, you should be eligible to refinance or purchase a home again.
Mm-hmm. So thank you for that. And I put up the screen from a Housing Wire article here with the most recent updated forbearance guidelines. This is what we were talking about earlier. Hugo, most directly to answer your direct question there is after a month, you decided to call the bank and cancel it, which common inference here would say that you didn't need it. So can you refinance in case you need it? There's the answer right there. There is no waiting period for borrowers who requested a forbearance due to COVID-19 financial hardship, but ultimately were able to make all their payments full and on time. Notice the emphasis on the words there. So as long as you've been current on your mortgage, boom, there you go. What Celeste was sharing with us a moment ago was in the case that maybe you weren't current and how to get current and then how could it work. But ultimately the answer is yes, you can as long as you're current. Nathan, thank you so much. Nathan says, thank you so much for your explanation. I locked at 3.625% on my closing on April 10th. And then goes into more detail right here. Let me see what we're saying. If it feels right, it really is right, really helped to make it. Oh, thank you so much. I'm so glad that was helpful to you. That must have been one of those. I recognize your name, Nathan, from the comments, and I'm not sure if that was one of the responses or if it was something you picked up on in a video. Even with over 600 videos out there, I'm very consistent in saying certain things. And that's one that I've always said since making videos. If the situation feels right, it usually is right. And make the well-informed decision. And if it doesn't feel right, don't make the decision because it's usually not right. So you got both principles there. And I actually learned that thought and came to see it in practice, Celeste, from Judge Judy. Judge Judy Scheinlin, I used to watch her all the time, and she would say, usually if it doesn't make sense, it's not true. It's just not the truth. So I thought, well, if it usually doesn't make sense and it doesn't feel right in your body, it's also usually not true. And common life experience. It's like being in a bad relationship when you know it's bad and hoping that it's going to get better, but it never does. It only gets worse. And it's also like knowing when things are right and it feels right and everything just goes along and it's easy and it's natural the way it's supposed to be, it only gets better. So Nathan, I'm glad that that comment has helped you. And I hope that it helps everybody else that's watching today too. And good on you, my friend. Super glad that you're able to get a good rate there. Norm says, shifted people to less densely populated areas due to what has happened will keep suburban and moderately rural prices up. I wouldn't want to own real estate in a downtown area right now. It's a very interesting observation, Norman. I think that you have a great point there. We'll see how the migration patterns ultimately pan out. In the 2020 predictions video, I was talking about migration patterns of Americans and where they tend to go. And they were already headed to less densely populated areas for housing affordability. Some of the economic and job opportunities, some of those areas were beginning to provide based upon some of the tax incentives and other options they were providing bigger companies to increase the actual job pool in those areas. So there was already a trend before COVID-19 of especially first-time homebuyers, millennials in specific, going over into some of these less densely populated areas that may be like, let's say, an hour and a half outside of a major metropolis in case they had the need of being in that city for work. So I think that's really interesting. But specifically being in a downtown area, yeah, I think that's really interesting. And we're going to have to see how a downtown center area plays out in real estate and moving forward because it is so densely populated. So thank you for that observation. I really, really appreciate that, my friend. ABCD says, when is it a good time to buy a house? ABCD, we have been addressing that throughout the stream, my friend. Ultimately, the answer to this one, let me just put it back into the simplest of ways to understand, because whether you're looking to buy or you're looking to sell, It really comes down to number one, gaining clarity on the reasons that are important to you to purchase a home or to sell a house, okay? It all begins with clarity. The second thing that it's time is to focus, and the focus on your job security, focus on how long you're going to live in this house, and come up with a game plan moving forward, whether now is a time that's right for you for the reasons that are important to you. Now, ABCD, I'm going to ask you to actually bust out a pen, some paper, and write that down and put it on there. Now, I don't care. I'm just going to be honest. It's just a secret. If you use a Word document, no one's going to know. It's okay too. So the point is to type it out, write it down, because doing so is going to move from your brain, your heart, and your soul onto paper. And that's when your logic is going to start kicking in, and you're going to be able to make a well-informed decision that's right for you, because now you're adopting that hashtag JTAB where you're just taking a breath to reassess. Ultimately, the best time to buy or sell a home is when it makes sense in your life for the reasons that are important to you. Now, the other considerations, again, job security, economic situation, and everything else, these are the factors that we need to gain clarity upon. So I'd ask you to do that, my friend, and then take into consideration everything that we shared previous in this stream and in a lot of the other streams we've done previously. Thank you for the question, ABCD. Paul, thank you so much for being here, my friend. Paul said, I had just refinanced my house to a 3.375 from a 4.25 when another lender called me about a 2.75 rate, so I was bummed. Sounds like a bait and switch on potentially the 2.75, Paul.
Yeah, sometimes lenders do that. And your question to that lender should have been, how many points am I paying? Especially if they haven't even taken a loan application for you, they haven't ran your credit. How do they really know what interest rate, you'll qualify for based on the market for that day?
It's a great point. So, Paul, I wouldn't be too bummed about it. It goes back to that example we were making in real time I'll just do it again, right there. They just like to keep doing it. So I'll just make the example again. Now it's saying, well, what if that person called you and said, we give you a 2.6 rate? Then again, you got to go through the cycle. You got to understand what type of loan that you're getting. They got to assess your economic profile, your financial profile. They got to assess your debt to income ratios, yada, 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 how many points are being purchased, all that fun stuff. So anybody can use a teaser rate. And that's what I call those, teaser rates. If you went from a 4.25, it sounds like to me, you probably bought sometime in the last 5 to 8 years for that rate, maybe a little bit longer. And it was a great rate back then. But now if you went to a 3.375, my friend, you've got to be saving bank on your mortgage right about now, because that is a huge drop on your interest rate. So good on you. You made a good decision that you felt comfortable with. Good on you, my friend. Don't worry about the shiny quarter. Let's not be an ostrich and swallow that quarter, because it'll choke us. Just saying. Right.
Just got a visual there. That was interesting.
There you go. Anna A says record low inventory right now and record low rates. You're absolutely right, Anna. Thank you for the observation. A Biogenesis says, but gain clarity that what you just said is an opinion, not a fact. If home values go down next year, everything you just said firmly is a wrong information. A Biogenesis, not sure if you're a troll, not sure if you're just making a speculation, and I'm not sure if it's just your conjecture or your opinion. All the same, I can respect it and appreciate it. This is a safe place in the live stream, and I do value different points of view. The reasons that I say what I say will go into my 2020 prediction videos and all the prediction videos that I create. So a Biogenesis, it is important to also gain clarity on the truth of what I said and how I said it to better understand the reasons behind it. That's what I'm going to ask you to do. So my challenge to you is to dig deep and gain clarity on everything that I really just did say, because everything I just said could not possibly be firmly wrong information, because it's based in sound logic and facts. And when we operate on facts, not fake news, not speculation or conjecture or opinion, we now operate in truth. And that's the third angle of that coin. But all the same, I respect you. I respect your point of view and your opinion. And thank you for joining us. Drews Enthused says, cheers. All right, Drews, thank you for joining us for a bit, my friend. It's great. Very, very helpful. Very, very helpful that you were here. Biogenesis then says, conversely, if home value sustains or doesn't go down, then the advice holds merit. Look, you're going to be right. You're going to be wrong. It's going to be whatever it is, right? We're going to see with time, 2020's hindsight. I make those prediction videos not saying that I'm some sage or some oracle, right? Because I'm not. I make those videos based upon fact and massive amounts of research, and also real-time trends called being a full-time real estate practitioner, watching how the market's behaving, being a student of life and being a student of the real estate market, sharing my observations with you openly and honestly so that people can make a well-informed decision, sharing the information where I found that information with people so they can do their own independent research to make a decision that's right for them. So Biogenesis, again, appreciate your points of view. Appreciate your comments here. They are valued, and you're welcome back, of course, anytime, so long as you're not a troll. Anna A says, all your content is great, Andrew. Thank you, and I really appreciate your support. Drews Enthused says, Mr. Adams said it best, don't panic. You got that right, my friend. Absolutely right. Don't panic. When you panic, it causes chaos and confusion. Nicoletta, oh, she did make it. Thank you so much. I'm glad you were able to join in, Nicoletta. We were talking before we got into the viewer Q&A about what you and I discussed. Celeste Harvey made some comments about her thoughts on the matter. So please let me know how everything turns out for you, Nicoletta. So glad you were able to jump on the stream, my friend. Anna says, hi, Andrew. Thanks for all your well-explained information about the market in this extreme times. Anna, thank you so much. That's what we're doing this for. Only way to keep track of everything is to go live and go after it, and keep the updates happening. Just like earlier today, Celeste was giving us the forbearance guidelines, and yet we were just last Friday, we were talking about forbearance gone wild, and just a month before that, Bill and I were talking about forbearance too. There's so many changes. So we're going to keep going on and keep explaining this information to help as many people as possible. All I ask is that please share it around with whomever you believe will help. Put it out on your socials. You never know. Somebody could find it, could make a difference in their life. Thank you for joining us, Anna. Utah says, if someone files for forbearance, can you still refi to get a lower rate? Utah, that's a great point. And I will be linking this article in the show more description after this live stream, because it really boils down to those three categories right here on this one article, whether you're going to be able to do a refinance. And everything actually depends if you're current, how many mortgage payments have you missed, if you missed mortgage payments, and becoming current for a period of time, in this case, 3 months. And this is the most recent forbearance guidelines. So I'm going to put that in the link below, Utah. Thank you so much for your question. It's also early on in the stream, I believe 2 to 3 times Celeste shared that with us. So good stuff. Thank you for being here, Utah. Oh, wow. Lani Hona Loa Hoku in Lime Alantas. I think I got that right that time. Quite possible.
That's actually pretty good. It's a lot better than I would have done.
Pretty good, right? It helps that I have some families that I work with from Hawaii, and they teach me, no, Andrew, you're saying it all wrong. So I think it helps a little bit. It starts rubbing off over the years, right? So if we can, let me just go with Lonnie. So Lonnie, morning, if I didn't want to pull so much money from my 401k to purchase, say an additional $4,000, and seller willing to add it to the purchase price of a new build, would increase my monthly mortgage by only $17 a month versus a higher 401k loan payment, which would be better at a 3.3% interest rate. Thanks. Do you have a consideration on that, Celeste?
Well, what I think this viewer is trying to say is, should they get money from their 401k to purchase a home, or is the seller giving concessions? Is that your take on it, Andrew?
So she's buying a new home construction, and the boiler.
Or is the builder giving concessions?
Quite possibly. So in this case, Lonnie, I'm just going to boil it down to make it very easy, based upon my thoughts, and just take it with a grain of salt, and then assess your situation against it, please. So when you ask me that question about pulling money out of your 401k to purchase, that certainly is an option, and it definitely helps some people in the home ownership. If you don't need to do that, and you're saying an additional $4,000, and the seller is willing to add it to the purchase price of the build. So in other words, the builder is saying, yes, we'll add the additional $4,000 that you need, and it's only going to increase your monthly mortgage at $17 a month versus a higher repayment on a 401 loan payment, which would be better at a 3.3% interest rate. Number one, factor the monthly cost for cash flow purposes. Number two, factor the return on your investment, potentially in your 401k, against the rate that you're paying out on your mortgage. And there we have the truth of the situation. In this situation, it would seem that it might be better sense to leave your 401k alone, so that you can go ahead and enjoy your future selves, or your future self will be enjoying the hard work that you're putting into it right now. and go ahead and take that 4K at the $17 a month if it's not going to hurt your cash flow position. Okay. That way you're not going to be hit with a higher 401k loan payment. That's what I would say. At 3.3%, so low interest rate, I would say roll with it and go with it. It's your call. Let us know what you choose to do. Thank you for being here, by the way. Anna says, do all VA loans require an impound?
Yes.
That's straight up. Thank you. So thank you. Kathy Martinelli says, I agree. Thank you. Of course. And she says, lots of laughs at Judge Judy. Judge Judy's a very smart lady. Just saying. I absolutely adore her. Seth says, I'm trying to decide whether to buy now and carry about a $1,000 a month in credit card car payment debt service, or pay that debt off now from savings and then purchase in about 6 months. Thoughts?
So, Seth, this definitely depends on your debt to income ratio. So I would get with your mortgage loan officer and run a credit report, figure out what your debt to income ratio is. You might have to pay this debt off, or you may not have to pay it off. And you can kind of discuss with your loan officer what makes sense for you. And maybe you don't have to pay these debts off to qualify, but maybe you might find that for your personal budget, having these monthly payments, from a credit card and a car payment along with a mortgage loan might just be a little bit too much and might put you over your budget for the month. So that's all stuff that you kind of just gotta hashtag JTAB, sit down, pencil it out, and figure out what works best for you.
Very good. Very good. Thank you for that. So Seth, I also saw that you made a couple more comments. I'm worried about overpaying for a house in the inland Southern California area right now, if we are in the middle of a fall in prices. And I also don't know financially which strategy would be better, even if home prices are stable. Seth, I think those are great points and considerations. And just to piggyback briefly on what Celeste said, I was having a wonderful conversation with a young lady 2 evenings ago. Her and her fiance planning on buying. They have some debt. They have great income, and it is also due to receive a bulk sum of money for a situation that's personal to them that I won't get into. All the same, the questions and considerations were the same. Should I service my debt and buy a home, or should I pay off my debt and then buy a home if you have it within your capability to pay off your debt? And that's the key there, capability. If your capability is to be in a full position to pay off debt and purchase a home within 6 months, then this is a real return on that thought process. Number one, it's going to impact your debt to income ratios positively by paying off the debt. Okay. It's also going to increase the amount of home you can purchase and afford if you so desire to purchase a more expensive home. And that's going to be, in my opinion, if I was in the Southern California market in the inland area right now, that's something I would be looking at first and foremost, is the cash flow position of paying off the debt, what the new proposed monthly mortgage would be, and getting with a loan officer to say, hey, you know what, at today's rate, a $600,000 house, what would my mortgage payment be based upon these variables, right? Now, obviously, that loan officer that gets you the straight scoop is going to need to run your credit, and you're going to need to provide your tax returns, 2 months of your bank statements, 1 month of your pay stubs, for that lender to truly hook you up with the different options available to you. That said, let's say that future forecasting, worst case situation, rates blow up, they're 5%. How's that impact you? This is a question I'd ask a loan officer once they have your file in hand, and then you can make a well-informed decision between those two. But ultimately, by paying off that debt, you're already going to be in a stronger position. And if I was working with you here in Vegas and that was your position, I'd probably say, hey, pay off the debt. The market's the market. It's going to go up, down, and all around. But what doesn't change is how much you owe on existing debt. If you have it within your capability to pay off that debt now and still be able to purchase your new home a few months from now, I'd say let's game it and let's go ahead and take care of that debt now so that you're in a stronger fiscal position going into home ownership. And 6 months from now, I'll be here when you're ready, and we'll keep in touch in between now and then. That'd be my thought. Lonnie says, what is today's interest rate? What's today's prevailing rate?
Today, I haven't checked the rates for today, but they are flat. So I'm just going to go off of what I saw yesterday for conventional loans. I locked in a conventional loan yesterday at 3.25%. Now, keep in mind, the loan to value was pretty low. It was below, 80% loan to value. Credit score was in the high 700s. So it really, again, just depends on what loan program you're going with, what your specific requirements are, what's the loan term, is it 15 years, 30 years, and an adjustable rate mortgage. So the best way to kind of figure out what your interest rate might be is to get with a loan officer and have them run your credit, have them look at your financials to figure out which loan program you qualify for.
That's good stuff. Thank you for those updates. And thank you, Lonnie, for the question. Zeke, thank you so much for joining us, my friend. Zeke says, thanks to you both. This is priceless information that you normally wouldn't have unless you were in contract to buy, sell, or refinance. You're absolutely right. And that's what my whole channel is dedicated to. And you can learn a lot about buying, selling, investing, savings, investments, and just the closing process in general on my YouTube channel. So I just go so deep. Not to try to bore people, just to give people the truth of the process so they know what to expect from the real estate agent and loan officers they work with. Because the reality is, even though our tribe is growing and we're coming up on 20,000, and hopefully one day we're talking about it in the near future, it's like 20 million, right? I know I'm crazy. 2 billion, right? Everybody in the world, right? But hey, it doesn't hurt to have aspirations, right? But that said, you're right. And the idea is to make sure that everybody knows how to think through this stuff, because it doesn't change anywhere you are, because we're all humans and we're all people. It's just about making a well-informed decision that's right for you by knowing the type of questions to ask, understanding what this process is going to look like, being able to identify when something is amiss if things aren't aligning in the process the right way, and gaining clarity on everything. So my friend Zeke, thank you so much. That really means a lot, and really appreciate your support, my friend. Jessica, thank you so much, Jessica. Jessica says, what exactly does under contract mean? Does the interest stay the same when closing? 2 questions. So what does under contract mean, Jessica? It means that the seller has accepted a buyer's offer, and it is also known as under contract. Sometimes you see it as like under contract show, under contract no show, pending, contingent. All of it means the same thing. The seller accepted an offer, okay? And does the interest rate stay the same when closing, Celeste?
So, once you lock in your interest rate, that is the interest rate you're going to get. So if it's not locked in, then the interest rate can change. It's dictated by the market and your specific qualifications.
Yeah. So get clarity on that with your loan officer, Jessica, if you're actually in the home shopping mode right now. And one of the things that I suggest, unless you're working with, well, even when you're working with Celeste and Bill, especially, I always suggest this no matter who you're working with, is to gain understanding from your loan officer that you're working with about their recommendations of when to lock. Because I know that Bill and Celeste watch what's happening, and they get these alerts to lock, which normally means there's a proposed rate hike coming up very quickly, and sometimes that same day, matter of fact, and it's time to start locking down the best interest rate. Sometimes they'll get this information that says, hey, rates are steady, but looking like they're going to dip. Hold rate locking until we know this specific ounce of news, right? And in that case, they would share that information with you and say, hey, the rates right now are really good, but if you want to risk it or if you want to chance it, they might get better, but they could get worse at the same time. So it's your call. And that's a true statement, because it just depends on what the news that comes out that impacts it. Like, let's take, for instance, when Celeste and I were talking about the ADP payroll report and the BLS job employment situation. Normally in the wake of that kind of news, you would have seen a rate drop, but we saw that week rates go up. So it's one of those things to understand. But these are the things that loan officers look at, Jessica. So please keep strong communication with your loan officer, and let's see if we can help get you the best rate possible for you when you get ready to close. Once you rate lock, then yes, essentially that rate that you locked at will stay the same. Correct me if I'm wrong, Celeste.
No, you're exactly right. When the BLS report came out, a lot of loan officers and consumers might have thought, oh yeah, interest rates are going to go down, so let's wait to lock. But when in fact it really didn't have any impact on the market, and maybe you could have got a lower interest rate by locking in a week earlier rather than waiting. So during these turbulent times, I would definitely always recommend, if the interest rate looks good and it makes sense, let's just lock it in.
Thank you for that. So Kevin, this is a very interesting comment, Kevin, and I'm not sure that you're going to like my answer, but it will be an honest answer. Take it for what you will. So Kevin says, what about if I invest my mortgage payment into the stock market and I request forbearance. Isn't that smart? Stock is going up. Why home value is going down? No, it is not smart whatsoever, because you're playing with the roof over your head. And you're presuming that home values are going down opposed to what we're observing in practice. And even if the home prices go down, from the economist at Zillow, from the economist in the National Association of Realtors, from the economist at realtor.com, all of these chief economists for these larger corporations that specifically monitor housing prices say that if the house prices go down, it's going down by 2 to 5%. In the worst case situation, 5. In the best case situation, obviously none. It'll just be flat, right? So where am I going with this? You're gambling. I hope you're not in Vegas, because you might need a gambler's number, but all the same, you still might want one, because you're gambling, and you're gambling with a very big risk. You're speculating that that the stock market is going to continue to incline and do its thing. What happens if it role reverses and goes back down? Now you've lost all that money that you should have been paying for your mortgage. You gamed the forbearance process, which should not be done, because people that truly need forbearance need that money, not you, if you're able to maintain and pay your monthly mortgage, right? Let's be honest here. Remember, we as people are always stronger and better together than we are not. And we got to be responsible, not be greedy. Greed is what got us into a 2008. So let's not do it now, okay? Just because a vehicle exists to game it, okay? So right now it might be gamed, but it's probably not going to be gamed. If you say, hey, I requested hardship, and then they found that you could actually pay it, you could be looking at penalties and fines. And you could also be looking at laws changing in the future that could actually call that a criminal activity. So that's the long-term vision. That's playing the long game here. Ultimately, it's the worst idea ever, Kevin, in my thought process. Don't do it, is my recommendation to you. Pay your mortgage. Invest whatever money that you have on the side. If you choose to invest it in the stock market, then invest it the way that you see fit. Pay your mortgage. Don't game the forbearance process, please. Lastly, ending on please. Okay.
Please, please.
Right. And I'm glad that you brought that up, Kevin, because for reference, I don't believe there's any such thing as a stupid question. So I'd rather you air it out here and hopefully take what I have to say to heart and with a grain of salt, and you're going to make of it what you will. But at the end of the day, at least now you heard a different position than what you may have been hearing that got you to think that way. So Lonnie said, did great, builder credit, awesome. Thanks, you guys are amazing. Lonnie, thank you so much, my friend. Greatly appreciated. Glad that helped. And much aloha, mahalo to you and your ohana. See, I know a few words. Yumi says, hello, Andrew. When does it make sense to buy down the rate? Thank you. You're the best. Yumi, you're the best too. Thank you for being here. Ultimately, if you're able to buy down the interest rate, it's going to save you some money. Or it's like, Bill and I have talked about that so many times. If that rate is like, when you buy it down, the cost of the point is like 1% of the home value. Sometimes it's less, interestingly enough. But, when it is, and it's going to have a big hit, like 0.25%, that's pretty significant. And the way that whether it's the best time, whether it's going to make sense to you to buy down the rate, really going to revolve around the question, how long are you going to live in your house? That's number one. Number two, what type of a mortgage is it? Is it a 15 or 30-year fixed, right? Because if you say to me, well, Andrew, this is a 3 to 5 year property, no, probably not going to make sense to buy down the rate, in my opinion. But if you're going to plan on holding that house for 10, 12, 15 plus years, or potentially a forever home, absolutely going to make a sense over the life of your loan, and absolutely going to save you tens of thousands of dollars. So I hope that helps, because that's what goes through my head personally and professionally when I get asked this question, keeping in mind, I'm not the loan officer, Celeste is, but this is what goes through my brain as a reasonable thinking person to help people make sense in the questions I ask myself when facing the same questions. And I hope that it's helpful to you, Yumi. Seth says, yeah, that's the issue. I think I will qualify, but I feel safer entering without that debt. Good point. If I pay the debt off, I will have less money for the down payment. That's true too. And let's see, so the rate could be higher, or I may need PMI. Thank you for that. I appreciate it. So Seth, I see you thinking out loud right there. So that's really good stuff. And Seth, yeah, you're right. If you have 20% saved up for a down payment, you go on a conventional loan, you're not going to have a PMI. It's a great point to make. So add that into your equation and your thought process of how long it would take you to reach that 20% to 22% loan to equity stake in your property, so you can reach that 78% and 80% loan to value ratio. Because the reality is, if you are using that conventional loan product, that is private mortgage insurance, which can and will drop off of your loan once you reach a certain loan to value ratio. Now, Celeste and I talked about this, Bill and I have talked about this, and we've all done it on live streaming on various videos where they said, hey, at the end of the day, if that's the situation, what you want to do is to gain clarity and insight with your mortgage service provider, how those rules work, and at what point would the PMI drop in that case. So going back to your previous statement, it just depends on how much home loan you're looking to get, because if you did jump in the market now owing that money, you're not going to get approved for as much as you could if you wanted it more home. And I don't know that you do. I mean, if you get approved for $10 million, you don't have to buy a $10 million house. Just saying. You buy a house that's comfortable to you and affordable to you, right? But if you're able to qualify for the home that you want now and carry that debt, then you might want to give a little bit of a stronger consideration into watching what the market's doing with interest rates and timing that rate to not time that rate essentially 6 months in the future when it could be higher. So that's worth considering as well. So I'd ask you to gain clarity and perspective on that and really get clear on when you can drop that PMI. Now, an FHA loan, just for reference, everybody, FHA carries what's called a mortgage insurance premium, and that does not drop off for the life of the loan. So it's a little bit different unless you refi out of it. So a little bit different. Kevin says, sounds good. Thank you. Well, we have been streaming one of the longer streams, and it has been so much fun to be here with you today. And I love the great questions coming from our tribe. And lastly, Celeste, do you have any thoughts or parting shots you'd like to share with us before we adjourn, before you get back to your Margarita Friday?
Well, I just wanted to say, thank you everyone for tuning in today. I know interest rates can be kind of a tough topic. So if you guys have questions about anything, or, maybe you're looking to purchase or refinance in Nevada or California, I'm licensed in both states. So please reach out to me. There's my contact info, my personal cell, my email, my website. You can literally just click on apply now, fill out an application, and we can get right to it.
Fantastic. Thank you for that, Celeste. And to everybody, thank you for being here. It's very much appreciated. I'm looking forward to coming back with you guys 9 a.m. on this upcoming Monday. And in the meantime, please go out there, be the reason that someone smiles today, and together we can make the world a better place. Thank you. We'll see you Monday.